Okay, well, let's get started. Welcome, everybody, to today's PACE webinar on the danger of production variances, or the accounting terms are KPIs. And I'm excited to be joined here today with Jay David, who has extensive experience in both accounting and operations, who's founder of Do Business Better, who will help unravel this mystery. For those of you who are not familiar with PACE, we're the Profitability Analytics Center of Excellence. We're a professional association dedicated to help organizations make better, more informed decisions through the use of data analytics. If you'd like to become a member of PACE, it's free. I encourage you to do so. You'll get access to all our myriad of resources, our webinars, podcasts, articles, ebooks, and more. And you can just go to profitability-analytics.org and become a member. I have a little bit of housekeeping before we get started. If you'd like to receive CPE credit for today's session, be sure to use your actual first and last name when you signed in. If you need to edit your name, go to participants at the bottom of your screen, then hover over your name on the list, click on the three dots, and you'll see an option there to rename. Enter your correct name, of course. Please note that you have to attend at least 50 minutes of the session today and answer at least 3 of the polling questions in order to get CPE credit. The session is being recorded, so I'd ask you to keep your camera off and your microphone on mute. We will be answering questions at the end of this session, but feel free to enter them in the chat as we go along. Having said that, over to you, Jay.
Thanks, Rafe. Thanks for having me again, and look forward to a great discussion here today. Hold on here. First off, the objectives of the webinar today is to understand the source of production variances and how they're calculated, understand everything that goes into the creation of these variables, but also that diminishes the use of the variances beyond just valuing cost of goods sold. And then we'll talk about some alternative measures to use those variances at the end. This is a big introduction, but I'll summarize. I'm a former cost accounting controller for a large candy company that came together in Illinois many years ago, 5 different ERP systems and 10 different plants. I later began tiptoeing into operations, worked in operations analysis and a budget director. Later, I was a chief operating officer for a $300+ million site, cross-border food manufacturing business. And then as Do Business Better, I work with businesses that need to find out how to achieve profitable growth and do other turnaround work with them, both in the food business, but you can see a couple of equipment manufacturers, printing business, and right now working with a professional services firm where I'm working really hard to challenge the concept of billable hours and how those are created and how that impacts their revenue model. I'm also the recent author of Turnaround Revelations, which hit #1 in the production and operations category very soon thereafter. And what I believe, cost management is about getting the most value for every dollar spent, not every dollar cut. Most people believe that cost management is all about cutting. A business should focus on managing those fixed costs, but the focus should be more around driving revenue with a greater focus on truly variable costs, driving revenue that will consume all of those fixed costs and balance them out. And that's the next point there. Capacity utilization covers fixed costs is the key to success for large manufacturing firms. And the key one, and I'll touch with it later, is most manufacturing management teams lack an understanding of operations finance. It's a foreign language to them. So my background, again, I lived in both silos, the finance side and the operations side. I was also the guy who did the massive spreadsheets to do all the allocations that I'm going to talk about later. But then I was also the guy presenting the variances, but also having to answer for the variances from the operations side of the business. Um, in my history, production variances uh, don't really provide a lot of insight. They force a lot of people to explain and just kind of justify uh, the explanations that they aren't really clear on. Uh, they bring up defensive conversations rather than valid operational improvement conversations. But they also, again, highlight the communication gap between operations and finance. So the standard cost architecture, standard costs require 3 steps. Most budget processes begin with a sales forecast at SKU level, customer level, month by month demand projections. That ends up driving the operations budget where they look at the demand that's been placed on the factory. And then they have to build their labor staffing assumptions off that, machine capacity utilization, and shift structures. And then they also can do maintenance planning, planning time for shutdowns for large scale maintenance work. And then it goes back to finance typically, where they will budget, they will take all of the costs that have been budgeted and then roll them together. And usually there's some back and forth. The budget's never approved on the first go round. But then that drives locked in standard costs that include material, labor, and overhead. And then from there, they build the absorption models and set up the ERP system. So within the standard cost process, the material standards are based on expected input quantities. Usually the purchasing people will figure out what the economic order quantities are, the most efficient purchase. The problem here is many times purchasing wants that lowest unit price, so they may assume a purchase quantity of 300,000 impressions of film as a minimum, but then later in the year they can't achieve that, so they make quantity purchases at less quantity, which can drive up prices. But then they'll also lock in expected purchase price from anywhere from big commodity items that are contracted down to small ingredients that might be used in hundreds of pounds throughout the year. Labor standards are built again based on that sales model going into a production model. How many expected hours are needed for every product to be made, and then they will project labor rates with fully loaded components that include benefits and other compensation models. Some businesses will use one labor rate for a factory rate, but others that have a higher disparity of rates might have general labor and then a couple of classifications above that drive their costs. Overhead standards, really, it's the overhead spending budget, account by account. And normally that should be intended to be designed based on the expected revenue and production flow going through the plant. But we'll learn a little bit later, most of those are fixed and really not able to be modified. And then that is divided across expected production volume to get to an overhead absorption rate. So in simple terms, the rate is budgeted overhead divided by budgeted production units, and then that becomes applied to product cost. So with all of this, this embeds sales mix assumptions directly into product cost because operations budget usually is a reaction to the sales budget. So for those who may not understand cost accounting to the same degree, labor hours are posted in the ERP system via a routing. So usually it's output per man hour, unit output per man hour. From the issue becomes you have sub-assemblies and then mixes and other things that might happen. So you'll have a bill of material for a the creation, and my background was candy. So you'll have the labor routing for making the candy. You might have another labor routing for the mixing of that candy, and then a separate labor routing for the packaging of that candy. So routings are set up again based on labor usage at each point of the process there. And these layers pull labor through from production through packaging to the finished good. Labor cost, as I mentioned before, most places do a single labor cost, but there are some that do kind of a graded labor rate, especially if there's a large disparity in maybe packers to machine operators and so on. So the rate is bounced against the output per man hour, which comes up with a costed routing that is applied to every product in the system. So we'll go to the first question here, and it's not related to content, but just some of the history. So if you were to guess what percentage of companies are still using traditional standard costing evaluation, what would that number be? And the poll is up on the screen right now for everybody. And Rafe, let me know when everybody's answered.
Okay, I think this is as good as it's going to get. I will push out the results.
The answer is D, 80%. There are obviously a lot of people on ABC or other modifications to standard costing, but still 80% are using standard.
Okay.
So I'm going to go through again a little quick wrap up of the definition of cost. In typical terms, most people just talk about variable cost and fixed costs. And there are more classifications in there, all having their own characteristics. But fully variable costs, there are only really 3 to 4: direct materials, shipping costs per unit, and sales commissions. Everything else beyond that might have a component that is variable, but is not fully variable. In the controversial topic here that I've highlighted, most people throw direct labor into this as classified as a completely variable cost. That's only true if you can make your employees completely variable, that if your production schedule ends Wednesday at 2 p.m., that you immediately send everybody home. And that's not a very good way of running a business, and it very rarely happens. So direct labor is really a mixed cost, not a truly variable cost. Once you do material cost and labor cost, that the combination of those two is prime cost. And that is still a good number. I've always wanted to look at sales, gross margin over prime cost versus over fully absorbed cost. That is a good number to understand. It's a clean number because it doesn't have all the allocations in there. In my first cost accounting job with a candy company in Chicago, we had our standard labor rate, and our owner did not want to see fully absorbed cost. He just wanted prime cost, labor and overhead, and that was it. Our overhead rate was simple. It was 235% of labor cost. And he ran a very good business because he knew he was covering his fixed costs, and he sold on an expected margin over prime. And I applaud him for that. Mixed costs, examples are utility bills, maintenance labor, salaried teams with variable bonuses and such. So the controversial one here is utility bills. A lot of applications that I've seen in the past, they assume electricity and gas and everything are completely variable. If you're not producing, they're shut off and they're not used. But there are big fixed components to every utility bill. connection charges, and so on. There are peak charges and base rates and things like that. And in reality, in most manufacturing businesses, it's not the production equipment themselves that drive electricity rates. It's the compressed air units and things like that. So those are more global. So utility is definitely a fixed cost and must be treated differently. I also look at costs and time sensitivity. Within this month, most costs are fixed. It's very difficult to react on the 20th of the month to make cuts to impact either this month's or next month's numbers. And in this case, mixed costs are for this month are mostly fixed. Small incremental changes might appear, but they would never be equal to the percentage of lost sales or production. In the next 6 months, the variable portion can be impacted by more efficient planning and usage. But there is always a time factor on costs. Stepped fixed costs are another one that's different. In some cases, you can't just add incremental pounds. If your production goes up by 3% and you can't handle that in your normal shift structure, even with overtime, and you have to consider adding another shift, that shift comes with a full staff of people to run the production line. In many cases, a production line might need 7 people just to be able to be turned on and run. You also have to bring in quality, maintenance, and other support functions within there. So those are called step costs. If you need to increase, they come in, they're chunky. That's the right term for it. So the controversial term, I mentioned that there. And again, time sensitivity, it's really fixed within current capacity. In the next 6 months, they are a little more variable, but they, again, come in big chunks. You're either adding a production line that wasn't running, or you're adding shifts or something else. Fully fixed costs, rent, leases, depreciation, salaried staff who do not vary with volume, insurance, and all other types of administrative. The issue that comes during this process of standard costing is we take fixed costs and we label them as fixed, but then we treat them as variable when we unitize them by dividing the fixed costs by units produced. We have to do that to comply with GAAP accounting, but once that's done, the assumption is an extra case that is produced increases rent, increases salaried staff, and something by what was allocated to that product from the beginning. So that's one of the biggest flaws with allocating fixed costs and then using them for anything other than GAAP accounting requirements. So after that, we allocate costs. And they have to be done, obviously, I mentioned for GAAP purposes. They're shared expenses that support the entire operation. So the quality department, the maintenance department, and everything cannot be tied to a single product. So they need to be allocated. And it's required for financial reporting and inventory valuation. In my world, in my past, beyond that, any use of that fully loaded product cost for any business decision making is a big challenge. And how are costs typically allocated? On labor hours, on headcount, things like uniforms, cafeteria expense, and other things might be done on headcount. Machine hours, sanitation costs might be allocated on square footage. Depending on the complexity of the product mix that you have, some places will allocate overhead on material dollars. Some just on production volume. I've seen it done on a straight per pound basis. The other one I've seen is allocating overhead to products that have a higher margin. They therefore have the ability to absorb more fixed overhead. I've seen that as well. So they're trying to maintain a little bit of a full gross margin approach there by burdening the ones that can handle it. And why allocations can be misleading. Allocations assume a relationship between activity and cost, even though the relationship may not directly correlate. And again, as I said before, producing more units can give the illusion of increasing fixed costs. So now the second question. What is the approximate ratio of CPAs to CMAs in the USA presently? The answer is 10 to 1. I thought that was very interesting when I researched that. And for all of you taking the test to make sure you get your credits, at the end, I will also have a free offer for my audiobook. So stay to the end and I'll let you know how you can get that as well. So what happens when we do this allocation, when reality hits and the numbers come in differently? So when you set your sales forecast, that's usually done in August, September, October, tweaking in November, locked in early December. Things are going to change. That is never set in stone. And therefore, any variance to that sales forecast is going to create some chaos when it comes to how we absorb overhead and labor into our P&L. So customer ordering patterns might change, marketing demand changes. There might be a war in the Middle East that creates short-term blips on sales demand, substitutions, supply constraints, and so on. So the biggest deviation usually occurs in the sales mix, which usually leads to a change which always leads to a change in the product mix. But rarely do finance teams do enough analysis and drill down on the mix impact, and we'll talk about that later. So where do the variances come from? Each product carries material, labor, and overhead cost assumptions from the budget process. So during that budget process, the ERP system is set, run rates are locked, batch sizes, lot sizes, and all the other variables within the ERP system are locked down. Purchasing has their standard EOQs. They base their pricing off that. They base freight assumptions for inbound freight on that, and then they've locked their material prices. Overhead has been allocated based on the assumptions of capacity utilization at that time. And I've been in organizations where we might be 72% utilized on our capacity. So when that allocation of overhead, which again mostly is fixed, is allocated on a factory that is not fully utilized, you end up with higher than average overhead rates that then create problems when it comes to your pricing assumptions as well. And then the sales and therefore the product mix assumptions have been set in stone at the beginning of the month. So then each unit produced, when a job order is closed, a unit draws each cost factor from the standard cost and puts that into a variance holding account. And then at the end of the month, the actual spending for each area is bounced against that holding account, and the resulting positive or negative number becomes the variance. So the variance framework, and this is where some of the variances can provide some insights, but they should be limited to these types of insights. So material price variance many times might be a sign of bad planning and expediting, or purchasing at less quantities than were anticipated in the planning process, or expediting, flying materials in. Usage variance, most manufacturing businesses backflush material usage at standard, so that can mask some of the usage variances until cycle counts are done. But when those cycle counts are done and you see large variances on a single item, then that gets you at least an indicator of when you should go back and review the actual usage of that and why you're seeing consistent usage variances at month end. On labor, rate variance usually is driven by overtime. Very rarely in manufacturing plants are you taking a completely different compensated group of people and doing more menial labor with them. But overtime is usually the biggest driver here. The efficiency variance means that we're either running slower, we're incurring more downtime, or other factors. So it's greatly affected by mix. You might be running a lot of smaller run items, which creates a lot of changeovers, but it also might be a sign of maintenance issues. So that one can get into your scheduling efficiency and so on. And maybe your desire to produce C-level inventory items at a greater quantity to avoid those small runs and changeovers. Overhead variance, spending variance is mostly impacted by mixed costs because the fixed costs are locked. They should be dead on to the budget if they were budgeted properly. The volume variance, driven by sales shortfalls leading to a slower production month. That's the single biggest issue for overhead variances, for negative overhead variances. And the purchasing price variance, usually again is a sign of purchase differential. And again, specific experience here, as products are being developed and commercialized in the beginning, I've seen negotiation between sales and cost accounting and purchasing. Hey, this new item is going to start out slower, but it's going to build, it's going to be bigger. So figure your assumptions on buying cartons not at 20,000 per unit, at 100,000 per unit. That negotiation happens, and if the sales never come in, you're always short buying and getting a different unit cost then. So there is an attempt to allocate better, and that's usually through the practices of activity-based costing. So many businesses try to do better with this by allocating overhead more precisely, by looking at many different drivers. They model them and then come out with what they believe is a much more accurate process. But in the end, the structural problem is there. They've still allocated costs that are fixed or mostly fixed. And the minute that they are embedded in product cost, then they react as variable costs. So using activity-based costing in all the modeling is fantastic when it comes to analyzing opportunities to be more efficient in those areas. But once they become embedded in product cost, and then that product cost is used to make decisions, pricing decisions and other, that's when the trouble begins. The problem next, and this is where I've been on both sides of the aisle here, is that once variances are out there, they become operational KPIs. So a bad month of sales leads to a bad month of production, and then leadership, usually 10 to 12 days after close, is looking backward. They're looking at a large variance that hit cost of goods sold, that impacted the gross margin expectation for the month. A little bit of panic sets in. So they interpret the faults behind those variances and will point to inefficiency, waste, poor cost control, and operational underperformance. So what ends up happening is, out of that meeting, plant managers and operation leaders go back and say, we need to reduce labor. We've got to increase machine utilization. We've got to attack areas that may have other impacts in the past. They may defer maintenance and cut out preventive maintenance programs or pull out a necessary shutdown because they have to fight back against previous months of unfavorable allocations. So they believe all these are to close the variance gap. And the behavioral consequences, again, by doing all of those short-term measures to try to cut costs to offset that variance, will harm the business in the longer term. You'll have reliability problems, increased safety risks, possible deterioration of quality, and which will impact long-term cost increases. So production variances may be valuable accounting signals, and I mentioned it in a previous slide, but you can look at budget adherence. So really, you're looking there at spending versus budgeting, not necessarily the allocation part and how much was applied to production. Cost control monitoring. Yes, you want to monitor efficiencies and see if your efficiency rates are matching what your assumptions were at budget time, and also some financial planning feedback, and understanding really how you're utilizing capacity. In a big factory environment, capacity utilization is the single biggest driver of cost. And if you don't understand your costs well enough, you will price too high, you'll struggle to get revenue, and then that huge fixed cost machine that is the factory will overwhelm your revenue. The biggest issues I see is that the perception is that operations controls the spend, even on fixed costs. So in those meetings, it is typically operations who have to react to those negative variances that are perceived to come out of the plants, even though most of those costs are fixed. So what ends up happening is when fixed costs cannot be cut, and we know that they can't in the short term, they have to take a much bigger bite out of the truly variable costs. So that sends purchasing back to negotiate, find new vendors, buy higher quantities to get their unit costs down. This is where layoffs come in and all sorts of mandates to have zero overtime and so on. So because fixed costs can't be impacted, they pound on all the ones that can, and that is very destructive to the business. The last question: when leadership interrupts, I can't read it now. When leadership interrupts unfavorable production variances as operational inefficiency, which of the following most commonly occurs? Everybody got that one. Almost everybody. All of the above. So the name of my business is How to Do Business Better. So I use that tagline as much as I possibly can. But now we're going to talk about how to do variances better. And the single biggest thing is, and I don't even have it on this slide really, is variances primarily are a gap mandated function to properly value your cost of goods sold at month end. Beyond that, their use is very limited. But my plea to the finance teams in the world of AI and much more advanced ERP systems is for everybody to do a better job of deciding the specific impact of product mix variances on both sales and production. Sales, building a bridge, revenue based on volume in units. What is the impact of that? And it needs to be drilled down. It shouldn't just be a single number. Bringing that number into a financial results meeting, again, 10 days after the month, doesn't really help a lot of people understand the true impact there. And the product mix impact on price and margin contribution also. So when you're doing that type of analysis, maybe it's the top 10 sales misses or sales changes that drove the variance from that perspective. It at least needs to be out there and talked about. I've been in so many of these meetings where sales, if this data is not presented, they are able to sit quietly and kind of listen as that number goes by, and then the pressure then gets put on the operations side. On the production side, based on the actual product mix produced, what were the hours at standard versus the actual hours used? Not the hours at standard based on what should have been produced versus the actual hours of what was produced. And that's the key difference. Then you can look at truly how did they perform with the mix of product that they actually produced. Assess actual run quantities against standard assumptions. If a product was supposed to have a normal run rate of 50,000 cases, and all of the production of that item came into chunks of 8,000 case runs, usually that is not an operational issue. That is a scheduling issue that may be because of short POs by the customer or something. But and it's not, again, to point fingers, but it's just to say, let's understand the impact of that. Did we run the quantities we thought we were going to run? Material variances, actual versus standard usage based on the actual mix. Possibly look at a top 5 items here. So robust cycle counting processes are important. ABC stratification. And certain items should be counted at the end of every month and trued up. Historically problematic problems, like in our case, it might be gelatin, should be on the list as well, because that's a high dollar value item also. So you don't really know your true usage rates, usage variances on materials unless you cycle count those items. So strategically cycle count high value items. I had a client that imported fish from around the world, and they ran sushi operations. They did not cycle count the tuna at each one of their locations at every month. And that was singly the highest value item. So now they are truing that up at the end of every month and understanding a lot of where their scrap and misuse goes. Purchasing, assess a mix, the impact of mix affecting purchase quantities. Again, if the expectation was to always buy 100,000 cartons and the sales mix has changed from the forecast, and sales demand on an individual item has decreased, that's an impact. And again, that is not really for the purchasing folks to answer. That question needs to be put to sales, and the full team needs to look at it. And then also develop KPIs that correlate directly with actionable work that can be understood and impacted. Instead of accounting variances be presented, focus on scrap and yield calculations. Those are things that were also embedded into the ERP system in the beginning, but those were items brought forward by operations and commitments by operations. So instead of just a percentage material variance, dive down deep onto scrap and yield calculations. It's not that hard to do. And single efficiency numbers, tie those more to throughput and downtime. Again, those would be built into the system, run rates, and so on. So those are easy to report against. And finally, this is the key. Just as accountants don't understand engineering terms, engineers and operations personnel don't understand accounting terms. But in most of these meetings that I've been in my entire career, dating back to when I was on the cost accounting side, the finance people speak in their terms with based on fiscal months, accruals, allocations, and so on. And a lot of operations people are in there like it's a second language. They're nodding their head and they're saying, okay, 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 but they really don't understand it um, in most cases. So we need to have an alignment on how operations is going to be held accountable. The measures that they're going to be held accountable to and need to discuss every month should be fully understood and agreed upon by all parties. And they need to be directly able to be impacted by the operations team. I've seen a lot of KPIs out there that when I go to the person that's on the accountability list there and ask them to describe that KPI, many times I get, I don't know. Well, do you know how you can impact it? I'm not sure. So that is on leadership overall, both executive, finance, and operations leadership to make sure their teams understand that. And also a company drill down data to allow for responses. Again, in AI, the world of AI and spreadsheets, that shouldn't be as difficult as it once was. And this goes back to a lot of the work that the folks with PACE do and all of the people on this call. We need to train operations finance to plant and non-finance executive leaders. I'm doing my part. I'm building out a very extensive curriculum on operations finance that I'm going to be offering to my clients. And it's going to dive deep. So plant managers and others will have a very deep understanding. Without this expertise, and a lot of even finance people don't have a deep knowledge. If they haven't worked in manufacturing, they don't have a deep knowledge about the things we just talked about. Without that, the CFO becomes a single source of truth. And I will tell you that I once in my career had to take cost accounting uh, instead of the CFO because he came in without experience in manufacturing and didn't understand all of what was happening there. So in that case, even the CFO was lacking the understanding. So again, most leaders don't know what they don't know. And an advanced step, and I've come up with this through a lot of research, rather than building your absorption numbers off of your current capacity usage, build it off of your assumed full capacity usage within that current shift structure. So I know in my past we had certain departments that the volume running through it might equate to 2.3 shifts. You can't run that product in 2 shifts, and you don't want to run it in 3 shifts. But we would value the overhead from that department based on the pounds going through. Those products would get an extra dose of overhead, then leading to pricing decisions that were very difficult to actually fill up that. So when you do it based on full capacity usage, it then becomes a KPI that is shared by operations and sales. Sales gets a little bit of a overhead reduction, which should lower the threshold of where they should price. That price should also be looked at as margin over prime cost, but then it becomes a team approach to filling up that capacity for the business to succeed. So as I promised, this is how to reach out to me. You have my email address there, my website. I'm on LinkedIn. There's my book. The audio book, I'm getting the audio file later this week, and I need somebody to show me how to email that out. But if anybody wants this presentation, I'll send it out in PDF format. Just send me an email. And if you want that, I will also send you the audio file to my book. I did not write the book to make money writing the book. I wrote the book, number one, to get my message out and to help people understand that there are different ways of looking at just about everything in the business. And that's why the book is named Turnaround Revelations, because in just about every topic in the book, I take an alternative approach to it. And I'm done, Rafe. I think the time was just about right. And thank you all for your attention today. And I am open to questions.
Well, thank you, Jay. That was a very interesting presentation. So much of what you said today resonates with what we talk about at PACE. The need to have an operational understanding of an organization uh, tied in with the accounting and finance operations, because otherwise you are just looking at variances and which really don't give you that understanding of the organization and that you need to effectively control it.
Yep,
We do,
agree.
yep, we do have. Uh, we do have a bunch of questions. Feel free to share your questions as now, because we will be addressing them now. But I also want to push out the final poll question, and please answer that before you leave. But at this point, we'll get to the questions. And let's see what we got here. Okay. Let's see. First one, you mentioned variances can become KPIs. Can you give some examples where that happened?
In just about every business I've been in, back from my Kraft and Nabisco days, in the with the old company, with the tea company that I mentioned there, and the local company that I worked with, KPIs of variances were always presented in the month-end meetings that included operations, sales, all functions, and usually the onus to answer those questions as to why there was a labor variance, what's going on with the material variance. Those answers were pointed to the operations folks. So I would say it's more routine than an outlier.
You, you know, Listening to your presentation, I'm wondering if there's a difference in emphasis depending on whether a company is private or publicly held. Of course, the publicly held ones are accountable to their shareholders as are all companies, but they
Mm-hmm.
worry about their stock market pricing.
Yep.
Is that a concern? Do you see a
Yeah.
difference in level of concern there?
Well, it's at the end of the day, it really becomes who understands the variance, who reports against the reason for the variance. And I guess my general point here is if you have it on a continuum, it leans against operational inefficiency as the root cause to those variances rather than sales mix being the largest contributor to those. So that's present in both private and public companies.
This next question, I think, is a very loaded question, but since you've had beaten both operations and accounting, you can answer it impartially. And that is, why don't non-financial leaders understand standard costing and variances?
Um, Not to offend anybody, but their eyes glaze over because there's so many different variables that don't align with what they're doing on the floor on a daily basis. The accounting calendar, is it a fiscal month? Is it a calendar month? The 445 week, accruals. So when they ask questions about numbers, oh, that was based on an accrual. That'll reverse next month. And again, that their daily basis is focused on the floor. How do I get, enough people to run my shift today? I've got schedule changes I've got to worry about, and they don't have the ability to say, I can't manage that schedule change because in 3 weeks, when I sit in the finance meeting, I'm going to have to address an efficiency variance. They just kind of have to get it done. And so what I'm trying to do is to make it somewhat user friendly that says, I've done both. So as an operations guy, I can explain to the operators, here's what you need to know. This is what you might be told about the reason for an accrual, and here's how it really impacts you. So that's, I think, where my curriculum will resonate.
Yeah, I think that's absolutely the case. might as well be speaking Greek to the operational folks who
Yeah,
really don't operate in their daily lives in those accounting terms.
right.
Another question, uh, do you believe that variances, as we know them now, are only for cost of goods sold calculation?
Well, as I pointed out on a couple of the slides, not only, um, many times we use directed cycle counting when we saw variances on specific items. One time in my past, it was red 40, which obviously nobody wants to use anymore, but we always had month end adjustments on red 40. So that action was driven back to the production floor with some industrial engineers, cost accountants, and operations folks and say, let's find the source of this. We're using 10% more every month than we committed to doing. So that drove action, that drove a bill of material change, which drove a cost change, and then it tightened it up. But so that was a small item. But in our world, again, if you're using 10% more corn syrup or sugar than you're using in making candy, that's a massive impact. And that knowledge of that variance, it drives action.
Good. And we have time for one final question. And it's a reminder that accounting and finance or management in general is not just all hard skills, the soft skills and behavioral issues are also important, perhaps more so.
Yeah.
And it's question, is there a lot of change management that has to go with the new KPIs, or are they understood once they're put in place? Is there still KPI gaming going on?
Um, in my book, I have a chapter specifically about KPIs. It was about a small company when I entered, $5 million a year, about 14 employees. They had 65 KPIs that they were using. Eight people, eight account KPIs per person. That was the exercise I said when I went in and asked people, do you understand the KPI? No. Do you understand how to impact the KPI? No. So the direction I give in the book is KPIs should be formulated with those who are going to be held accountable to it. Hey, I'm thinking of this measure. How do you think about that? What makes sense? Well, I control 20% of that, but not the other 80%. Such as a purchasing person being held accountable when a pallet arrives of material on the back shipping dock that has a stretch wrap that's torn on it. That is a bad KPI. So KPIs should be we, not you and me. They should be we, developed together and understood between finance and operations. And again, with ERP systems and AI, it's easier to dig and get at much better measures than uh, overhead absorption variance.
Good. There's actually one last question which I do want to ask because I think it is a good closing question. And that is, what's been the biggest lesson learned in your experience with regard to KPIs?
I think I referred to it, in that earlier example. In If a KPI is not understood by the people who do it, malaise sets in and they just ignore it. But the bigger side of that is, in many cases, compensation, evaluation of the employee, and bonuses are aligned to their ability to deliver on the KPIs. So what happens if you have a KPI that they don't understand, don't feel that they can impact? Guess what else happens? They're saying, I'm not going to get a pay raise anyway, and my bonus is not going to be paid anyway because it rarely gets paid already. So you get you suck the energy out of the production team, and that's the single biggest issue. In my craft days, we used QCDSM: quality, cost, delivery, safety, morale. Stand-up meetings, 5 minutes at the beginning of every shift, very laser focused, actionable KPIs that everybody discussed every day. By far the best system I've ever seen.
It certainly sounds effective. So again, thank you, Jay, we're going to wrap up here. Thank you for a very interesting presentation. It's certainly the meat and potatoes of our profession, something we all need to be aware of. And your message so much is in alignment with our PACE framework. It's great to talk with someone who is of one mind with what we propose. And I want to just remind everybody to keep an eye on PACE's LinkedIn channel, where we'll announce future webinars in our series. Uh, Visit our website to find out more about our activities, sign up for our newsletter. And having said that, thank you all and see you next time.
Thanks, Rafe.